What's up everyone, it's Karthik with MoneyVest. So in this video, I will be breaking down exactly a little bit of that bearish divergence that we are seeing between the S&P 500 and the NASDAQ 100 as well. NVIDIA is reporting earnings later today, so after the markets close, and it's really going to come down to this particular company and the stock, whether we are going to break out of this divergence or not. So as always, if you enjoyed this video, find it helpful, make sure that you drop a like and subscribe to the channel. I would really appreciate that. Check out the link down below if you are interested in joining our community with 16% annual discount that expires at the end of this month. And that will give you access to every single Discord channel, as well as our Patreon community and our website as well. Consumer confidence hits highest level in over 6 months in August. And this right here, we've got the most households are now heavily allocated to stocks in the highest levels in over 70 years. So we are seeing a market which of course is very, very bullish and very broad based. There's a lot of participation not only from households and businesses, but also from other parts of the market. So other sectors are also pushing higher, a little bit over 40% now is that threshold, highest level in over 70 years. Now, before we move into the divergence and a little bit more about NVIDIA stock, I really want to go over the Federal Reserve rate cuts and what sectors actually tend to perform much better, right? So this right here is going to be small caps, mid caps, and large caps. And you'll notice that small caps have gained the most when the Federal Reserve has started cutting interest rates, right? So performance after the first rate cut, 26.6%. for small caps in the first 12 months. So this is actually quite interesting data because Tom Lee, as we already know, is also very bullish and very optimistic on IWM or small caps or Russell 2000. And I've also been very bullish on IWM and small caps for the very reason because I do feel there's a lot of potential opportunity in that particular sector. It continues to trade at a relatively speaking undervalued or cheaper value relative to large caps and mid caps. So that is actually good to see that we are seeing a 26% on average gain for small caps after the 12 months, 6-month performance 14.2%, which is actually quite comparable to mid caps. And then of course, large caps here 9.4% and 15.6% after the Federal Reserve rate cuts. And that happens because the rate cuts actually do benefit small caps more than they do large caps. If anything, I could make a case and make an argument for why large caps actually tend to perform, or not really perform, but it's actually a bad thing for them as interest rates come down, because then their cash that is now invested in marketable securities and treasury bills earns a lower yield relative to what they were used to seeing at higher interest rates. So small caps, again, lower interest expense, better valuation story, and they're able to finance their debt cheaper. Definitely does benefit that part of the equation. Now, this right here is the earnings estimates for S&P 500 moving forward. And as I mentioned before, this is quite literally the only thing that matters when you are investing in the markets, nothing else. It does not matter what's going on with the recession fears. It does not matter what's going on with interest rates. All that it really matters, all that it comes down to at the end of the day, it all boils down to earnings per share and where net income is going to be for these companies, because collectively, if the companies are growing their profits, they're growing their productivity, markets are going to reflect that, right? Markets are inherently going to reflect the productivity and the growth in earnings and margins and profits. So this right here is 2026, about $320, 2025 at 274, 2024, 239. So there's a nice little acceleration in earnings over the coming years. That's what the markets are pricing in. I'm actually going to be doing a video. It's going to be a little bit more of a political video, but not focusing on the political or the presidential candidates, but instead talking a little bit more about their tax policies, or at least the anticipated tax policies, whether it's Trump's tax policies of reducing the federal income tax and moving more towards a tariff-based taxing system, or it's Kamala Harris talking a little bit more about unrealized gains being taxed. So I'll do a video more from an economic standpoint and how each tax policy may affect the markets moving forward. So if that's something you'd like to see, comment down below. Now, this right here is from Fannie Mae. Talking a little bit about the economic forecast moving forward. And this is where we are currently in 2024. We've got the GDP growing at a nice 2.8% mark for the second quarter. Again, personal consumption expenditure, which is inflation, sitting at 2.3%. And they are forecasting a soft landing scenario where GDP continues to grow really well, 1.9, 1.6, 1.4, 1.9% in a year later. So 2025, mid-2025, and then again, normalizing a little bit closer to 2%. And personal consumption expenditure, in other words, inflation, which is the Fed's preferred measure of inflation, coming down to 2.2, 1.7, 1.6, 1.7 again. So that is going to be that expected number from Fannie Mae in their expectations for the Federal Reserve, in terms of interest rate cuts and as also the inflation and GDP growth here. Now, let's just come over to some of the divergences that I am witnessing in the markets, and it's actually quite telling with what's happened in the past and what is potentially could happen in the markets moving forward, because you'll notice that the QQQs more specifically is starting to roll down. So we are witnessing a little bit of a lower high over here. So this right here, a high, previous high, and this is a lower high. So this is clearly a little bit of weakness for the market because we're not able to get back up to the previous high or near all-time highs. And this right here is S&P 500. It's arguably a double top at the moment. So what I really want you to highlight here and really pay attention to is that every time you've seen a little bit of a higher high in the S&P 500, what we have really witnessed is a lower high in the QQQs. And every time that has actually happened, it's marked for a top in the S&P 500, right? So this right here, and that's essentially just one way of saying that NASDAQ is not leading this rally. The NASDAQ, in other words, tech stocks are not strong enough, or they're not having that much momentum or performance. In other words, there's lack of leadership in technology, which is why S&P 500 is not able to keep up with those gains, right? So QQQs diverging away from S&P 500, and S&P 500 continues to make a higher high. That simply means that tech is lacking leadership, and the other parts of the market are actually lifting the S&P 500. So you can make a case that, okay, this is a bit of a broadening of this market rally, and we're seeing, markets, other sectors participate into this market rally. But I would argue that that's actually both a good thing, but more of a bad thing, because if there's other sectors that are pushing higher, that are pushing the S&P 500 to make a new higher high, and there's technology kind of lacking that leadership, if that leadership were to continue, in other words, their lack of leadership were to continue and there was going to be some significant underperformance, the S&P 500 is eventually bound to come down, right? So that's been the top for the market. And once again, if you take a look at over here, what we really witnessed was, again, a little bit of a higher high for S&P 500. This was back in March of 2024. So that's the higher high. And then if you take a look at QQQs, once again, precisely from that point on, we had a lower high in QQQs. And that right there was a little bit of a top for the S&P 500. We ended up seeing a bit of a pullback once again. And if you come over to now, and now what we have noticed is once again a little bit of a higher high for S&P 500 as other sectors participate and keep going higher. However, QQQs is still struggling, and we are seeing a little bit of that underperformance in a NASDAQ, which we have already addressed in one of our previous videos, because I showed you guys the XLK versus XLU performance, which is also going to be listed over here. And again, we've seen periods of significant underperformance, which have led to more selling pressure on the entire market. Because as I mentioned before, if technology does not lead, the markets don't go anywhere. If technology leads the way, that's what creates these market momentums and these rallies back up to all-time highs, because there's a much stronger breadth in that market. I would much rather prefer a little bit of a broad-based rally where all sectors are participating and pushing higher. So, there's really a few ways the markets can essentially go up, down, sideways. If tech is leading and all the other sectors are participating in that leadership, or in other words, those gains, markets go up very, very much, right? Markets go up, see significant moves to the upside. If tech is going down and everything else is going down, of course, markets go down. But if tech is going up significantly and other sectors are coming down, so we can clearly say that there's a rotation out of other sectors over to technology, that will result in the markets going up just a little bit, right? It could be up like 0.5% to as much as 1%. And the opposite is also true. If technology is selling off aggressively, there's a lack of leadership in that sector, and other sectors are pushing higher. They're kind of trying to carry their weight, but it doesn't happen because technology still makes up over 30% of the entire index. And in that case, I think the markets roll over. They sell off, something that we have already witnessed in our previous discussions for market updates as well. So that is a bit of a divergence. And in order to break that divergence, we really need to see a breakout from this on QQQs. And that will obviously depend very much on how NVIDIA ends up doing later today. So NVIDIA pre-market, if you come over to this, right now we're seeing NVIDIA slightly higher, up about 43 basis points. So today is going to be the big day. And as we already know, it's kind of consolidating sideways right now in anticipation of that big move, which I think is about 10 to 15% in either direction. We just don't know what the direction is going to look like. But my expectations are for a reasonable 5% rally for NVIDIA, getting up to its all-time highs, possibly. That's going to be sitting roughly at $140 per share. So that's where we are with NVIDIA. And again, going over to some of the other things here. So implied and actual earnings moves for Nvidia and how accurate it has been. In the past, we had a 7 to 8% implied move, and actual was also in and around those levels. This right here, the actual move was significantly higher than the implied move. This right here, the implied move was a positive number. We ended up going down. Again, the actual move was significantly more than the implication. And this right here, again, the actual move was significantly more than the implied move here. Again, it's completely wrong in 2022, the implied move versus the actual. And I believe there's only a few instances where the implied move was actually more than the actual move here from the Nvidia earnings. But in more recent history, as you can see, that the implied always underestimates how much Nvidia can move post earnings. So that 9.7%, I'm taking that as a bit of an underestimation of how much Nvidia could move, but I'm still having a modest expectation of 5%. But I wouldn't be surprised if Nvidia kind of blows past that implied expected move here and goes up over 12, maybe even 15%. We'll find out. But that's going to be a lot of market cap that Nvidia would need to add in a very short period of time. We're talking hundreds of billions of dollars here. And as we already discussed in our previous video, the average market cap for S&P 500 companies, the other 490 companies, is about $68 billion. And if you take into account the next 100, not the top 10, the next 100, the average market cap is about $190 billion. So Nvidia's implied move right now is suggesting for Nvidia to add one full company to its market cap based on the average numbers that we've looked at for the S&P 500. And Nvidia earnings have been a key driver for broad market performance in the short term as well. So this is showing us the reaction to earnings highly concentrated with broader markets performance over the next 2 weeks as well. So earnings reaction, if you do see a very strong reaction, the S&P 500 performance tends to be very, very strong over the next 2 weeks here. So a 30% move in Nvidia earnings reaction leads to on average over 4.5% performance to the upside on S&P 500. And this right here, if you do see a 20% move, so anywhere between 10 to 20% move, we can see anywhere from 0 to as much as 2% on the S&P 500. So again, it's kind of crazy to see that one stock can have such a significant impact on the overall market. So that's all I've got for you today. Make sure that you drop a like and subscribe to the channel. Keep a close eye on this divergence as well, because if Nvidia starts to roll over, it's most likely going to bring the entire market with it, and that divergence on the QQQs, the Nasdaq relative to S&P 500 is going to continue, which could mark a bit of a double top for the S&P and could result in a bit of a pullback or a correction in the S&P 500 once again. Not to mention that September is coming up. It's right around the corner. The seasonality of September, we already know, is not that great. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Let me know your thoughts down in the comment section below. As always, happy investing. I'll see you all in the next video.